Stanley Druckenmiller, the billionaire investor that predicted the rise of Nvidia, updated his $4 billion portfolio at the end of the first quarter, and he's made some immense changes. He sold off 85% of his Nvidia position, which used to be his #1 holding just 3 months before. So let's see where he allocated his capital, what is his #1 holding now, and what he believes to be next in the stock market. But first, let's see what are some of the other positions he reduced and what all these have in common. He sold 56% of his Vertiv position after the digital infrastructure stock became really expensive with a price to earnings ratio around 36 times. Moreover, he sold 32% of data storage company Seagate Technology, and then he sold a massive 85% of Eli Lilly. Eli Lilly is executing very well with increasing margins and solid growth expected. It used to be Druckenmiller's 4th position, but the stock now trades around 18 times enterprise value divided by the next 12 months revenue, which is as expensive as some of the best AI companies, as for instance Palantir also trades at 18 times. Lastly, Druckenmiller sold 71% of his Nvidia shares. Nvidia used to be his biggest position just 3 months before, after he bought the stock around $183. But we later see that he has now a new top holding, which is a massive pivot from what he used to own. But before we get there, let's see the positions he liquidated, since he sold off some of his top 5 positions. Druckenmiller sold his entire position in stocks like Chevron, Lamb Weston, UBS, and most importantly, he liquidated his entire call option in Nvidia. This position alone was 7% of his portfolio and was bought just 3 months before, when the stock was around $500. In total, considering that he sold both the stock and the call options, Druckenmiller decreased his Nvidia position by a total of 85%. So naturally, people are asking, why is one of the early proponents of AI massively selling his AI stocks? Well, simply put, because they did too well.
150 to 900, yes, we did cut that position and a lot of other positions in late March. I just need a break. We've had a hell of a run. A lot of what we recognized has become recognized by the marketplace now.
So the main reason why Druckenmiller sold his AI stocks is because they grew too fast, and now the growth prospects are mostly priced in. Even if the AI market will keep growing, the stock prices already reflect this scenario, so there is less upside for investors. And one important factor why this is happening is Fed's pivot from December, when for the first time they hinted at cutting interest rates.
Why are we even talking about cuts? Because if you remember, we did trillions of dollars of QE because it was 1.7 instead of 2 over a decade. But somehow now that we're at 3, we've got to start cutting rates to bring in a smooth landing. So to me, it didn't make any sense. It was a huge mistake.
Fed's pivot from December was an important catalyst that disrupted all asset classes, including equities.
They set financial conditions on fire again. Bitcoin, I can't remember where it started from, but it went from like 30,000 to 70,000. Equities, obviously, credit, interest rates.
But besides the high expectations of the stock market, another factor that makes Druckenmiller stay away from AI stocks is the fact that the government is spending recklessly in a period when the economy is strong.
We've got a 7% budget deficit at full employment. It's unheard of. We don't need spending right now. We just need the government to get out of the way and let the private sector do its thing.
In his opinion, this is wrong, and as a result, the innovation in the AI space might be slowed down.
And my new fear now is that spending and the resulting interest rates on the debt that's been created are going to crowd out some of the innovation that otherwise would have taken place.
To sum up, on the short term, Druckenmiller believes that there is less upside in the AI stocks than it used to be, but he's still a firm believer in the long-term prospects, and he compares the growth in AI today to the growth of the internet in 1999.
If you bought the NASDAQ in 99, it went down 80% That's not going to happen with AI, but it could rhyme. AI could rhyme with the internet. As we go through all this capital spending we need to do, the big payoff might be 4 to 5 years from now. So AI might be a little overhyped now, but underhyped long term.
So, what is Stanley Druckenmiller buying now? Firstly, he increased several positions like data company ZoomInfo, manufacturing company Flex, which is now 2.5% of his portfolio, and networking company Arista, which now has a 2.8% portfolio weight. Moreover, he also increased his position in industrial equipment company Woodward and genomics company Natera, which is now his 6th biggest holding with 4% of his portfolio. But more interesting than the positions he increased are the new positions opened. Druckenmiller opened a small position of $17 million or 0.4% of his portfolio in Palantir at an average cost of $20.5. He also opened a small position of $20 million in Apple at an average cost of $184. He also invested $31 million or 0.7% of his portfolio in Meta at an average cost of $420 and $153 million in semiconductors company Coherent at an average price of $51. Lastly, he invested $664 million or 15% of his portfolio in his newest holding, IWM. This is the ticker symbol for the Russell 2000, which is an ETF that covers US small caps. It has exposure to many small caps in the US like Supermicro Computers, MicroStrategy, Carvana, or ELF. This is very different from what Druckenmiller used to invest in, since it is a diversified class of assets. Druckenmiller is known to take large concentrated bets like he did recently with Nvidia.
My idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully.
But his pivot towards small caps shows that this class of assets has potential upside for two reasons. Firstly, the main difference between the small caps and the large caps is the composition of the index. While the small caps have higher weights for industrials, financials and healthcare, the large caps index has 32.8% invested in tech companies. So making the small cap index his number one holding is another way for Stanley Druckenmiller to be pivoting away from softer stocks. But secondly, the most important reason why the small caps are becoming attractive is because this asset class might benefit from lower interest rates. These smaller companies take on debt to grow faster, so lower interest rates might make borrowing easier and the cost of debt will decline. Lastly, considering valuations, the small caps are cheaper than the large caps with a price to sales multiple of 1.3 times compared to 2.7 times for the large caps. If you feel like you've learned anything of value or you want to see more videos like this one, please hit that like button and subscribe. The YouTube algorithm really believes that you would enjoy this next video.